Now we're moving on and discussing a little bit more about the accounting cycle. We're going into the adjusting process. The adjusting process happens at the end of an accounting period. Now, some companies will do adjustments at the end of the month, some will do it at the end of the quarter, and some will do it at the end of the year. In my videos, I focus on an end of year because that's when we absolutely have to do them. We have to complete adjusting entries at least once per year before we can produce financial statements. Well, what are adjusting entries? Well, adjusting entries really are entries that are needed to simply bring account balances up to date before we produce our financial statements. What do you mean by that? Well, think about things that occur over time that may not be in our system yet, such as interest. Notice interest on a loan will accrue every single day that a loan exists. However, do we go in every day and say, ooh, we have another $5 in interest to record today? Absolutely not. The cost benefit just isn't there for that. So at the end of the accounting period, what we do is we look back and say, oh yeah, interest did accrue during this period. We need to update our financial information so that we properly report interest during that period. Another example is supplies, and let's use that as an example here and work through this handout. The ABC Pest Control Company had supplies costing $2,300 in its supply account at January 1st, 2022, at the beginning of this year. We had these supplies sitting there. On June 1st, the company purchased an additional $3,600 of supplies and recorded them in the supplies account. No entries were made as the supplies were used during the year. However, at December 31st, a physical count revealed that supplies on hand were 1,540. So let's look at this. Our company began the year with $2,300 in supplies. So if we were to look at the ledger, we would see a debit balance in our supplies. Remember, debit means left, so we're going to put that on the left side. We'd see that debit balance of $2,300. Now, what happened? Well, on June 1st, the company purchased $3,600 more in supplies. Now, this goes back to our prior videos, so let's really quickly record that. What did we do with those supplies? Well, remember, when we purchased those supplies, our supplies would have gone up by $3,600. Supplies is an asset, so in the world of accounting, we would actually debit our supply account for $3,600. So we go in and we debit that account. What did we credit? Well, that really doesn't matter. We're going to assume we paid cash for those $3,600 because it doesn't say anywhere on there on account. The point of this is the supply account, not the method of payment, so we're okay either way. Now, in that case, this would be an asset exchange. Our assets would go up and down by the 36. And it's going to mess up my formatting a little bit. That's okay. So let's fix that. So this is an asset exchange. We exchange one asset for the other. Notice we haven't used any of the supplies at this point that we know of. So it goes in. It's not an expense just yet. Now, statement of cash flows. Since we are dealing with supplies, this would be an outflow. Cash went down from operating activities. Now, go up here to our ledger. So in this case, now we just added $3,600 more to our overall balance. Notice that? So how much do we have in total? Well, we've got $5,900 in total supplies there. So if you wanted to draw a line and put 59, that's perfectly fine. That would allow you to see your balance. Now, on December 31st, though, we went and we did a physical count. Now, be careful. Sometimes when you're working these, it'll say the supplies used during the period. That tells you how much you actually used. Here it says supplies on hand. So at December 31st, we go back and we count our supplies. Well, according to that count, we only have 1,540 left. So think about it this way. Can we report 5,900 in supplies if we physically only have 1,540? Well, absolutely not. That would be misrepresenting the company's information. So we want to make sure we update that account balance. Well, what happened to the other supplies? Well, in theory, now granted, sometimes theft does happen. You know, your employees take home some pens or paper. They may not even realize that they grabbed it. That's okay occasionally. No big deal. But in theory, all of those supplies were used during our accounting period to help us generate revenue. So what happens on December 31st before we can produce any financial statement, before we show our balance sheet and say, hey, we have supplies in this company of 5,900, we need to update that balance to say we have supplies of 1,540. So what's going to happen there? Well, notice our supplies account has a debit balance right now of 59. Well, we need to bring that balance down from $5,900 to $1,540. So take just a moment and figure out how much we would need to reduce our supply account by. Hopefully you paused that video and did that calculation. So hopefully you see that we need to reduce our supplies by a total of $4,360 there. So what's happening? Well, we have a debit in supplies. We need to reduce our supplies by $4,360. So we need to go in and credit our supplies account. Notice we're simply updating the balance in our supply account. So when we go in here and we actually post that, and we put in a $4,360 if you want to, now at the end of the day, you should have a $1,540 debit balance in the account, the actual amount of supplies on hand. Now, as we consume assets, what do they become? Well, really, pencils and papers and things of that nature to us are simply expenses. So most of the time when you consume an asset, when we use an asset up to generate revenues, they do become expenses. It's the cost of generating revenue for the company. So we're going to go in and we're going to actually record supplies expense. Now, accountants aren't real creative, so most of the time when we're using an asset, it becomes the same name, only in expense. So if you use supplies, it becomes supplies expense. If you're using up a prepaid, like prepaid rent, it becomes rent expense. Prepaid insurance would become insurance expense. We're not real creative in our naming conventions because we want it to be clear and understandable. So as we consume the asset, it will become an expense to our company. Now, here's something really cool. Every time you record an adjusting entry, you're going to impact assets or liabilities. You've got to impact this portion of our balance sheet. So in this case, our assets are going to go down by $4,360. So that's one rule. You have to impact the balance sheet account, an asset or liability account. The second rule when we do our adjusting entry is it has to impact the income statement. The entire purpose is to make sure our financials is up to date. So every time we have an adjusting entry, we're going to hit revenues or expense. Okay, so in this case, it's an expense. So our equity is going down by $4,360 as well. So our expenses go up $4,360. Our income goes down $4,360. So it's that direct relationship. Every adjusting entry will impact the income statement and the balance sheet. Okay, that's one of that's two of the rules there. You have to impact both for it to be a proper adjusting entry. All right, now we will look at several different types of adjusting entries in the future videos here. That's the only one for today, just to give you that introduction. But all of our types fall into two categories, and there's three rules that you have to follow. And if you don't follow those three rules, you know you're wrong when you're doing an adjusting entry within a company. The categories, one are deferrals. Deferrals means to push off, basically. Recognition. What does that mean? Well, notice when we bought those supplies, we deferred the recognition of the expense until we actually use the supplies. So we push that off into the future. Deferred revenues are the same way. We push the recognition of the revenue into the future. So when we adjust it, we're adjusting a deferral to catch up to what the future has given us at that point. So here, we bought supplies. We had some supplies on hand. We bought some more in June. At the end of the year, in the future now, we have used up some of those supplies. So we've pushed the recognition from June when we bought those new supplies all the way to December when we know we've actually consumed those supplies. So deferral, it means to push off the recognition. That's your prepaid expenses, your supplies, your long-term assets, which we'll see a little bit later. The other is accruals. Accruals simply happen. We're not pushing things off into the future, but an accrual simply happens because of the passing of time. A great example of this would be interest, because interest, on day one, you borrow money today. Well, if you go to pay it back 10 days from now, do you owe the same amount? Absolutely not. You owe the interest that has accrued during that 10-day period. So an accrual means we have an event that takes place, and then due to the passing of time, it accrues or it builds up to a balance. And then at some point in the future, we need to record that balance. Again, it's not beneficial necessarily to record it every single day of the company's life, but we do need to record it before we produce financials. Another example of that would be wages, like salaries. Salaries accrue over a period of time. We record them at the end. So they accrue as the employee works, they accrue some salaries. Power would be an example. Right now, you're accruing, your power bill is increasing every moment you're sitting here on this video, assuming you're at home, you're using power. So you're increasing your kilowatt hours. That's an accrual. Those are the two types or two categories of adjusting entries. Now, what are the three rules? Well, first and foremost, when you're recording adjusting entries, you are not paying for anything. So you will never, ever, ever, ever use cash. Okay? Cash should not be involved. Now, we do sometimes have correcting entries that we will make, that we have to correct our cash, and they may fall at the end of the year. A correcting entry is not an adjusting entry. You're fixing a problem there. An adjusting entry isn't that anything's broken, it's just we haven't yet recorded things. So, rule number one, never use cash. If you're recording an adjusting entry and you're using cash, you are wrong. Let me just put it that way. I know it's not right to tell people they're wrong these days, but you are wrong if you have cash in an adjusting entry. The next thing, you must adjust one asset or liability account. Okay, well, if I can find my right button there, I won't underline in italics. There we go. Asset or liability account. In other words, a balance sheet account has to be involved here. Typically, it will be an asset or liability. Rarely do we ever adjust anything in stockholders' equity as far as common stock or dividends. Now, we do adjust a revenue or expense, which is going to be in our stockholders' equity. So you must adjust one asset or liability. That's your balance sheet account. And then you must adjust one revenue or an expense. Okay? That is your income statement account. You have to impact both the income statement and the balance sheet anytime you do an adjusting entry. Okay? So just make a note of those items because that will help you as you're doing adjusting. Do I have one asset or liability? Do I have one revenue or expense? You have to have one of each because you have to impact the income statement and the balance sheet when you perform an adjusting entry. All right, that's the end of this video. Again, if you're not in my class, always look down to the description because this handout is there. I should have mentioned that at the beginning. But if you're not in one of my classes, the handout would be located in the description of the actual video here in YouTube. Y'all have a great day. I'll post some more adjusting entry videos in the coming days. Have a wonderful work week.